Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Thank you for listening to this week Through the Noise podcast. I am your host, Heung, Senior Investment Strategist in Standard Chartered Bank CIO Office. And with me today is Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. And welcome, Manpreet. This week's podcast is actually for our second half outlook preview. May I start with the question with one key view in our second half outlook, which is the weak US dollar. And maybe can you tell us a little bit more why this is significant for other asset classes?
Hi, Ray. Thanks for having me on. You're right that one of our cornerstone views with the second half outlook is that we do expect a weaker dollar over the next 6 to 12 months with risk tilted to the downside. Now, since April, a lot of attention has been focused on the structural risk of de-dollarization. But in our view, shorter-term cyclical factors, such as the dollar's still elevated valuations, the potential for lower rate differentials, and uncertain U.S. trade policy should be sufficient to result in a weaker dollar over the next 6 to 12 months. And on the other side, of course, the euro, the yen, and even to some extent the pound sterling are likely to be the key winners from this in currency markets alone. But this isn't just about currency markets. So like you said, I think it's significant for other asset classes because history shows us that periods of dollar weakness are positive for global equity market returns, including US equities, but usually result in non-US equities outperforming US equity markets. And this history in particular plays at least one key role behind why we're overweight global equities relative to bonds and cash.
Yeah, thanks for that. I think that follows into my next question to you. So why we are overweight equities and how to think about different regions on the back of this US dollar weakness?
Well, we expect the second half of 2025 to be constructive for both economic and earnings growth, even though we do expect some bouts of volatility along the way. Now, hard data in the US has been resilient, and we've got supportive fiscal and monetary policy across the US, Europe, and Asia. All of this is why we believe the US economy can still achieve a soft landing. In other words, slower but still positive growth. So this macro view, together with our dollar weakness view, feed into why we're overweight equity markets and what's really a preference for a globally diversified equities allocation. Now, within that diversified allocation, regionally, we have moved Asia ex-Japan equities to overweight. Asian equities and I suppose emerging market equities more broadly have historically performed well when the dollar is weak. And following on from that, within Asia, we've also upgraded Korea to an overweight, which joins our existing overweight on Chinese equities. The bigger picture here being that North Asian equity cyclicality and more attractive valuations are what's really pushing us into these overweight views. Now, Korea, China, and to some extent Indian equities are enjoying domestic fiscal support and can benefit from a soft dollar view. In China, we prefer the more cyclical technology, communication services, and consumer discretionary sectors, while in India, we've got strong structural growth dynamics, a supportive geopolitical position, but here we really prefer large caps over small and mid caps within the Indian equity market. I would point out that European equities also are another attractive non-US equity market with still inexpensive valuations and improved fiscal spending, which should support the region's earnings growth in the coming years. Now, all this discussion, of course, of non-US regions doesn't come entirely at the expense of US equities. So we are still bullish on US equity markets. And like I mentioned previously, soft landing in the US economy, weaker dollar, they're both supportive for earnings, especially if the Fed also starts to cut rates in the second half of the year. From a sector perspective, that's consistent with our preference again for cyclical sectors of financial technology and communication services. The one thing I would mention, though, is that we do see US equities now more as a core allocation rather than an overweight. Given, of course, the historical evidence I discussed earlier, that US equities, while they might do well, they do struggle to outperform non-US equities in dollar weak environments.
I see. In that case, the backdrop is that we are looking at a weaker dollar. How does that translate to bond opportunities, especially if we're talking about any opportunities in dollar or non-dollar bond space?
Well, let me start with the non-dollar space because we have raised emerging market local currency bonds to an overweight. So, of course, that would directly benefit from any dollar weakness, but also, more importantly, any price appreciation if emerging market central banks cut rates further. Because if you compare it to the US or many developed markets, emerging market central banks arguably face more limited inflation risks and therefore have more room to cut rates. Um, but of course, that's one pocket. I think when you talk about US dollar bond markets, I'd focus on US bond yields because we really expect them to be a bigger driver of bond market returns compared to yield premiums or credit spread because those are already quite tight. Now, in our view, high quality bonds are attractive, while the 10-year US government bond yield is at 4.5% or higher. Because we do expect that yield to gradually move into a range of 4 to 4.25% over 6 to 12 months. I would point out that short-lived spikes in the 10-year to 4.8 or even to 5% can't be ruled out if we have escalations in trade, inflation, or fiscal worries. But even in that event, we'd view any such spike as temporary and indeed as a fantastic buying opportunity as long as our base case of a US economic soft landing holds. The last point I'd mention, of course, is that we think the 5 to 7 year maturity bucket in US dollar bonds, that offers, in our view, the best trade off between earning an attractive yield and getting sufficient exposure to price gains should yields fall, while avoiding what we view as excessive exposure to inflation or fiscal deficit risks. That's a little bit more inherent when you start going out to very long maturity bonds.
Thank you for that. This year, just switching gear a bit, we have actually seen quite a lot of risk events, and aside from the trade war that currently still ongoing, lately we have actually another uprising of tension in the Middle East. Is that something that we should be worried about, and how can investors manage or hedge these risks?
Well, you're right. From a risk perspective, there's indeed a lot going at this point in time. So, early July brings the end of Trump's 90-day tariff pause. We do expect extensions to allow trade discussions to continue, but of course, there may be some rhetoric that accompanies it. Meanwhile, of course, the Middle East and Ukraine-Russia conflicts continue to simmer, and the Middle East conflict in particular does pose the risk of a brief rebound higher in energy prices. Now, in a base case, we do expect these risks to result in temporary but not sustained volatility. The top three risks we'll be monitoring quite closely as we go through the second half of the year are, number one, any signs of a sustained rise in trade tariffs. Number two, a jump in oil prices as a result of what's going on the geopolitical front. And third, if we get any unexpected or sudden decline in hard US economic data that starts raising recession risks. So those are the risks we'd keep a watch on. To the second part of your question on what investors can do to mitigate those risks, gold, of course, is an asset class that we see as a core allocation. So that's one potential port of call. Central bank demand is expected to result in another leg higher in gold prices after we get through the current period of consolidation. But gold also plays a key portfolio diversifier role at a time when bonds are not playing that role very well. And staying on the theme of diversifiers, we also think alternative strategies are key to achieving diversification, regardless of whether you're looking at more liquid or private market strategies, depending on what you're able to access in your markets. Now, if I can spend a moment on Middle East risks, and not only because I happen to be in the region, but our base case scenario is that the Middle East conflict does not directly disrupt the supply of oil and other energy commodities. Geopolitical tensions may very well remain relatively elevated, but oil prices can be capped, as long as the supply is not disrupted. And in our view, that's thanks primarily to quite a bit of excess global supply. But we need to acknowledge, of course, there is a downside risk scenario that would emerge if the conflict escalates to a point where there is a direct disruption of oil supply. In that scenario, it would be reasonable to expect a sharp rise in oil prices, which in turn would transmit risk to global markets by raising inflation expectations. So in that kind of scenario, one would expect traditional safe haven and inflation hedges to outperform. Those include gold, as we discussed already, inflation-protected bonds, safe haven currencies like the Swiss franc or Japanese yen, and energy correlated assets, which would include the energy sector equities or currencies like the Canadian dollar or the Norwegian krona. So those are some potential risk mitigants.
Thank you, Manpreet, for sharing all the insights. So in second half, we basically are looking at a weak US dollar as a theme, which would lead us to suggest an overweight in equities, with Asia and Japan probably the leading beneficiary. And on the bond side, we overweight EM local currency bonds with a weak US dollar again as a tailwind. And these recommendations aside, we need to continue to be vigilant and monitor recent political risks and hedging the risk using gold, inflation protected stuff, and even go into some safe haven currency. And thank you all. That's just all the time we have for this episode. Thank you for listening. And for further insights, please remember to refer to our second half 2025 Global Market Outlook report, which will be available for download via the link in this podcast description. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.